Hey everyone, welcome to Retire with Style. I'm Wade, and I'm here with my trusty co-host Alex, and we're continuing our. Hey Alex, I see you
Hello.
trying to get a word in edgewise.
No, no, no.
But
Just
we're
saying hi.
continuing our series on the Retirement Planning Guidebook, the third edition that came out in January, fully updated for 2026, and also a lot more reader friendly than past editions. So if you're looking for a resource for retirement income, it's a good resource to check out. And we're continuing this week with the second half of chapter 11, talking about what the book covers, what you need to know for retirement. And the second half of chapter 11, Alex, is about tax planning with legacy and estate considerations.
Wow, but I do have a question beforehand.
Okay.
Why were you so reader unfriendly in your previous edition? Why did you decide to make this one friendly? I thought all the Wade versions were friendly.
Yeah, it's a good question. I guess when I was first making the book, I was thinking it would be more like a textbook for retirement income planning, and the longer the better in that regard. But with reviews that came in, they didn't always appreciate the longer the better philosophy, or the textbook philosophy. So without really taking away any substantive content, I was able to cut out about 100 pages just by really focusing on what you need to know and trying to explain it more clearly and accessibly. So I guess just maturing and growing, using that in making the book something it's still, if you're a very beginner, and in that case, you're probably not listening to the podcast anyway, the book could still be complicated, but I think it's a lot more accessible than past editions.
Look at you, always growing. I
That's right.
aspire to have that kind of
That's right.
ambition.
The book is a living document.
There you go. There you go. That was nice. So it's not the director's cut anymore. It's like straight.
It's
Just
been
just
edited.
the just the news you need to know. No, that's awesome. No, no, I agree, Wade. I think it's a better edition than the previous ones. It's like that Mark Twain thing. I would have wrote a shorter book if I had more time, something like that.
Brevity is the soul of wit.
Oh wow, look at this. Shakespeare over here.
To use that quote before, though. But yeah, the
Right.
third edition is, well, the full length, including the index, it gets up to 377 pages. But the 2025 update of the second edition, I think, was 507 pages.
There we go.
So I was editing.
I can't wait to read the Twitter edition. All right. So we're on the tax planning chapter here, the second half of it. And in the previous episode, if you haven't heard it, check it out. We talk about the basics. We're sort of laying the groundwork for estate planning 101. Uh, Not to roll up our sleeves a little bit, Wade, get right into it. How does tax planning change when preparing to leave an estate?
hmm So in chapter 10, when we talk about tax planning, it was about getting the most after tax spending and legacy from your assets, but legacy wasn't a specific consideration, or otherwise, legacy was more of a background consideration. There's three important points to consider when it is becoming more clear that there will be a legacy and or you're otherwise planning for a legacy. If you're not planning for a legacy specifically, the chapter 10 tax planning advice is you really do spend down taxable accounts first. Now you're blending that with tax deferred distributions, but you are on a track towards eventually the account that you spend down first is going to be the taxable brokerage account. Now, when there's a legacy consideration in mind, you might slow down the distribution of the taxable account because there's the step up in basis rules that taxable assets receive a step up in basis at death. So if you are able to leave taxable assets as an inheritance, any embedded capital gains go away. If you have a
Now,
low cost basis, if you distribute now for retirement expenses, you have to pay the capital gains tax. If you leave it for beneficiaries, they get a reset.
so so let me just make it clear for folks listening who may not be as well versed in just the terms we're throwing out. So if I buy a stock right now and I buy it for $10, I put, whatever, I put $100,000 into it at a $10, average price $10. And then if effectively 15 years later, I die and, the 100,000 is now worth $1,000,000, I've effectively made $900,000 on it. But not made, obviously, I pass away with that account being worth $900,000 of it. It goes 100% to one of my kids. They don't pay any of that $900,000 in capital gains, is what you're
Right,
saying. Alright,
right.
that's stepped up. They get the basis at the time of my death.
Right. That step up in basis means the cost basis. I think in your example, when you bought it, it was 100,000, but now it's worth 1 million. So it
Okay.
resets their cost basis to 1 million. Now, if they continue to hold on to it and it grows to 1.1 million, they'll have $100,000 of capital gains in there from the growth since death. But that $900,000 of capital gains that was embedded and that you would have to pay the capital gains tax on had you sold it during your lifetime goes away.
And so this is where you're getting at, that if you see yourself being able to not fume out assets and you're realizing I'm gonna have a lot left over because I don't wanna spend what I have, I can't spend what I have, it just doesn't feel right. What you're saying is the philosophy could begin to switch because now that you're going to leave a legacy behind, and legacy is just right now a nice way of saying you're gonna leave money behind, effectively, you wanna make sure that maybe you take advantage of the 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 cost the
Yeah.
carryover in cost basis.
Yeah, the traditional advice is you continue to
A
aggressively
step up.
spend down the taxable account, but to preserve that ability to get the step up in basis, you still every year the account's going to be kicking off income, the dividends and interest and so forth. You spend that, but you might not want to sell shares and realize capital gains. Maybe instead cover those additional distribution needs from the Roth IRA, or
Yeah.
you're more mindful of it's not necessarily a good idea to aggressively spend down that taxable account just because of the tax considerations and the benefits of the step up in basis.
And the flip side to this is I know you wanna deal with this towards the end of the episode, so that's fine. Because if you don't, and if you just leave, if you will, a Roth IRA at the end because you spent on all your taxable assets, your your inheritors are gonna get a different tax sort of dynamic than if it was a taxable account.
Well, yeah, an inherited Roth IRA is also a great thing to inherit,
Yeah,
but
but the tax there's go on.
well, there's no yeah, we'll talk about that more at the end, but there's not they'll still have to distribute out of the Roth IRA and reinvest in a taxable brokerage account, but they won't have to pay any taxes on the distributions from the Roth IRA. So it behaves pretty similarly to like a taxable
Yeah, the
account.
limit. Yeah, I was just referring to the 10-year limit kinda thing.
Mhm. Yeah, so it actually you get to distribute it out over 10 years to reset the so there is a little bit more tax benefit in that regard, but that's compared to getting a taxable account with the account equal to its cost basis. The fact that you can wipe out all the embedded capital gains in that taxable account is a huge benefit, which means you'd rather let your beneficiaries get those capital gains wiped out. It's okay to spend from the Roth IRA, even though the Roth IRA also has some really great tax advantages too.
Okay.
Yeah. Yeah. And so then other considerations are when you're thinking about the effective marginal tax rate management of I'm I want to make a Roth conversion, for instance, when I can pay at a relatively low effective marginal tax rate. When legacy is a consideration, you're comparing the tax rates you would pay by doing the Roth conversion versus the tax rates that your beneficiaries would pay if they instead inherited that as an inherited IRA. And that starts to get into the issues of if your adult children are inheriting an IRA in their 50s, they may be in their peak earnings years with really high effective marginal tax rates. And so, from the perspective of creating the biggest after tax legacy, you as a retiree might want to do the Roth conversions so that they would inherit an inherited Roth IRA instead of an inherited IRA, so that they then have a 10-year window to distribute the account. And they might be doing that at quite high tax rates. It's effective marginal tax rate management becomes comparing not just like how much would I pay now versus in the future, but how much would I pay now versus my beneficiaries, what they would pay in the future. And then
No, I
the
agree, and
third
that's what you said more eloquently than I did at the beginning. That's kinda what I was getting at.
Mhm. Yeah, and the third consideration is if you have multiple beneficiaries who will face different tax rates, that can impact how you want to distribute the assets. That just dividing everything up equally could be a lot less tax efficient than like the idea is maybe I've got two children. One of them is a really high paid professional who's facing the 37% income tax bracket. Another child has a lower paying job and might be able to manage distributions in the 12% income tax bracket. In that case, it, you might create unequal pre-tax distributions that will translate into equal after-tax distributions and much greater after-tax spending. The idea being you give more Roth assets, more like Roth type assets to the person in the higher tax bracket, more of the traditional IRA assets to the person in the lower tax bracket. But then you also give them a little extra to pay the tax bills so that after the tax bills are paid on those IRA assets, they receive more equalized after tax legacies. They're not equal pre tax legacies, but they're equal post tax legacies. That might require some explanation and concerns about it not being fair. But if you explain how this could lead to much larger after tax legacies for each individual, they might be willing to go along with that.
Could you imagine? "Hey, guys, I got an idea, but listen to the whole thing first before you say anything. Let me get to the end before you say anything. It's gonna work out, trust me." Could
Yeah,
you
yeah,
imagine that?
child A. Here's the idea, child A gets more than child B.
But trust me, it'll be fine. Could you imagine?
Yeah, so there
And
are
then the
some
other one
family
says, "I
dynamics.
knew it! I knew it! I knew he was your favorite." Alright. No, you're right, 'cause ultimately, it's what you keep, and so it's a way to harmonize it. On a level of complexity, what are you talking about here? From 1 to
Well
10.
well, I give an example in the book, and of course, part of it is it may be difficult to predict what tax rates each adult child would face because their financial situations could change. But, like, I create a simple example where there's $100,000 in an IRA and $100,000 in a Roth IRA. If you divided both of those counts equally between each child, the, final after-tax legacy is a lot less than what you do is you give $94,000 from the Roth IRA to the person in the higher bracket. You give the other $6,000 in the Roth IRA and all $100,000 in the IRA to the child in the lower tax bracket. The child in the lower tax bracket pays $12,000 in taxes from the IRA, and then they're both left with $94,000 after tax. And that's a lot more than they'd end up with if those accounts were split more. Well, on a on an after-tax basis, the person in the higher tax bracket would be hurt a lot worse than the child in the lower tax bracket. But they can both be made better off by thinking through this process
No, I think it's
strategically.
great. I don't think it's that complicated, but I just didn't wanna have folks, when you were kind of doing the initial explanation, thinking that's too much. I can't keep track of that on my Hewlett Packard, HP12C, whatever, that kinda thing. But it's not, I if you conceptually understand it, I think directionally it's fairly simple to pull off.
Mhm. And even if you are kind of forced into a constraint of providing equal pre-tax inheritances because the kids just can't wrap their heads around it, you still it makes sense to give more of the Roth to the child in the higher tax brackets. Although if they figure out after the fact that the child in the lower tax bracket got stuck with a bigger tax bill, they might still be unhappy, but more of the IRA goes to the child in the lower tax bracket.
What happened to the days of just thank you? Thank you for anything.
Yeah, those days are gone.
Alright. Now, in terms of estate planning, we talked about anything more about, efficient distributions with inheritance?
No, that's the idea because that's not yet into the estate taxes. Now we're ready to
That's where I
talk
was.
about estate taxes.
Okay, so right off the bat, what are the numbers here?
Well, in 2026, it's pretty simple. You have an exemption of $15 million per person. So you do this properly within a couple, potentially $30 million for a couple, is exempt from estate taxes. And then beyond those limits, you quickly go from, after another $1 million, you're up to a 40% estate tax rate at the federal level. So
Now,
estate taxes have a pretty high tax rate, and these limits can change over time. In the past they have been a lot lower, but at least right now, like, most households are not going to have to worry about estate taxes. The issue
okay,
is just it could change in the future.
and just because we've been talking about taxes and, the term waterfall versus non-waterfall, whatever. Let's say you're single and you die with $15,100. What gets taxed at 40%? The $100 that's over the 15 million or the whole thing?
Well, it would just be the $100 over 15 million. It's
I
just
keep
like tax brackets in that regard, but you don't immediately go into the 40% rate. It starts at 18%, I think. So there might be an $18 estate tax bill in that scenario. You just
fair enough.
freely.
Okay, the other piece is where does it stand, the 15 and 30 relative to historical numbers? Just
Oh,
to put things in perspective, and how crystallized do you feel this number is in the foreseeable future? And granted, things change, but just curious.
uh, as far as I know, these are as high as they've ever been. I don't know if there was any minor historical period where they were higher, but yeah, these are pretty high limits right now relative to history. And they're permanent right now in terms of they'll adjust for inflation each year, but it would require new legislation to change them. So that new legislation could come at any point in the future. But that's hard to predict. And that's just where we are right now, 15 million and 30 million for a couple.
Okay.
Now, some states do have their own estate tax as well. There's not that many. The states with an estate tax are Connecticut, Hawaii, Illinois, Maine, Maryland, Massachusetts, Minnesota, New York, Oregon, Rhode Island, Vermont, Washington, and the District of Columbia. And there's also an inheritance tax in a few states, which is more to when you receive the inheritance versus the estate paying the tax. In Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. And Maryland's special because it has both an estate and an inheritance tax, the only state with that. But those could match federal limits, or they could be much lower limits as well. So if you're in one of those states, state estate tax is also a consideration alongside the federal. So even if you're not going to hit the federal limits, you might still be hitting some state limits.
What's going on with Maryland? So I'm
Can't
I'm
wait to
part of
get
the
big.
DMV. What's happening here?
Right.
Well, the D too, the district as well.
Hmm. But yeah, and Virginia was not on the list, so you're good.
Yes, yes, yes. Northern Virginia exempt. All
Hmm.
right. And so those are the limits on the estate. What are the gifting limits?
Yeah, so then gifting gets into each year, an individual can give to another individual up to $19,000 as a gift that does not work against the estate. Any gifts in excess of $19,000 you then have to start keeping track of because that goes against your estate tax limits. You can't just gift. If you had a $15 million account, you can't just gift it right now and then avoid estate taxes on it. The first $19,000 would be free of consideration, but the rest of the gift goes against your estate tax limits. And then at the end would be part of the calculation of the estate tax.
And again, this is where the first 19,000 is no consideration, and then any
Mhm.
dollar over that, that's when you start. It's
Keeping
not a
track.
waterfall. I just want to make sure again for those folks. It's just the amount over 19. Now,
So then
how
people
did
might also start gifting right now to take advantage of the limits from now, because if those limits were lowered in the future, they'd be protected on the gifts they made while the limits were higher.
100%? And now of that 19,000, what happened? There's two things that happen, right? You need to keep track of it. Is there a tax involved, and for who? For the amount over 19,000.
Well, on gifts of over 19,000, the additional amount over the 19,000, you do need to keep track of that. There's no tax due now, but it will be counted against your estate tax limits. So if you had made gifts of a couple $1 million, you'll ultimately be fine because that's still under the $15 million limit. But uh, you might do this strategically now to take advantage of that limit while it's higher, just in case those limits drop in the future. It's going to count against the limits, and as long as you don't ultimately exceed the limits, you're fine. But you do have to keep track of gifts for the amounts over the $19,000 exempt amount each year. But that's per person and from each person. So a couple, they could each gift a child $19,000, so that's $38,000. And then if you have 5 kids, you could do that $38,000 for each of the 5 kids. And
Yeah, but that doesn't go towards the limit either
right,
because
that's all
they're getting
kept,
on.
not, you don't have to keep track of that. And there's also a special rule with the 529 plans that someone, often like a grandparent in this situation, could make up to 5 years worth of those gifts all at once. So the 19,000 times 5 could all $95,000 donated in one calendar year, not donated, but going
Yeah,
to the
yeah.
529 plan. And that also avoids, that's within the rules of an exempt gift.
And what is what when you hear the terms yearly gifting and lifetime limit, how does that work?
Well, if you just get in the habit of like gifting people $19,000, and these go up every year for inflation, but like $19,000 a year, that's a way to start getting money out of the estate without any sort of estate tax considerations.
When you hear lifetime limit, it's referring to the state ceiling.
Yeah, the
I
$15 million
Yeah, that's
limit
what I
now.
wanted to make sure. For folks listening, because you hear these terms a lot, I want them to understand, okay,
So if
lifetime
I
limit.
gifted somebody $20,000 this year, I'd have to keep track of the $1,000 over the limit. That would apply against the $15 million that is exempt from estate tax. So then if my estate was ultimately exactly $15 million, and we got to account for all these inflation adjustments, but the fact that I had previously had another $1,000 gift in there, well, I'm now like at 15 million, $1,000 as an estate.
There you go.
Gifting is not a loophole to avoid estate tax, other than you get that $19,000 limit each year that you can work with, which can add up over time if you're just
100%.
gradually making those gifts.
No, 100%, especially if that money's just gonna be invested and you're looking at 30 years that you're giving whatever, $18,000 a year to kids. That adds up in a significant manner.
Hmm.
And I think your point was well taken. You can give it, your spouse can give it, so then that's 2 injections going in.
Hmm.
It Yeah, there's a lot of avenues, for to potentially transfer this over if you do it in a steady and systematic way.
Hmm. And that can be a way to also provide the inheritance while alive and while you can enjoy the benefits of it, helping, even if it's used for a family trip or things, but just helping folks while you're still alive rather than saving everything for an estate at death.
No, 100%. Like, if I mean, look, if let's say, yeah, you're sitting on $8 million, right? And you know you're not gonna hit that 15 million. I mean, sorry, the limit. The 30 million for you and
Right,
your
but you may be worried that by the time you pass away, the limit could be reset to 1 million, and then you would have a huge estate tax bill.
I wasn't even thinking like that. I was thinking more like they know they're not gonna reach it. They just
Mhm.
said, I'm fine starting to gift now so I can see the benefits of it. But no, you're right. I mean, who's to say in a few years it doesn't go down?
Right, and it's not that far back in history. I outline it in the book of, was it in the early 2000s? Yeah, right here. So as recently as 2001, the individual estate tax exemption was $675,000. It was still only $2 million in 2008.
Yeah.
So the fact that it's $15 million now, that doesn't mean it's going to stay that way forever. So, and that's the, like, if you hadn't done any gifting, you're like, okay, I'm going to have about $10 million as an estate. I won't have to worry about estate taxes. I'm not going to do anything. But then the law changes, and there's now a $1 million exemption. You now have $9 million estate taxes are going to be due. So that's where you might still be thinking about taking some actions to
And
avoid
it
that
could
possibility.
now I don't know the answer to this. I don't suspect you'll know the answer to this, but I'm just thinking, let's say somebody for whatever reason gives this year $7 million, thinking, oh well, the state, the thing, the limit is 15, so I'm good. But they roll it back like the next year, and now you've actually gifted over the limit,
Yeah, I don't know exactly how that works, but my impression is they must do some sort of calculation of like
right?
if you donated 7 million out of the 15 million, that was almost 50% of what you're allowed. And so maybe they say, okay, so you've gifted
No,
50% of
I just thought of this right now, so forgive me. Wait, I'm not
yeah,
even putting you on the spot. I don't expect you to know this. I just thought that could be an interesting sort of. Uh-oh.
yeah, I think they do some sort of prorated calculation that you're not if you had gifted it with the current limits in place, you're not gonna have to worry about paying estate taxes on it. I think there's some prorating, but yeah, I don't know exactly how that works.
Yeah, yeah. But it would seem fair. How do we introduce life insurance into this mix?
Well, that can be a consideration for legacy. If it even if you don't have an estate tax issue, it could be a way to quickly provide liquidity to the estate so that they can cover expenses without having to liquidate, especially if it's like a business. If they're receiving a business, it could be hard to liquidate and receive liquidity from that business. So the life estate could be a resource, or life insurance could be a resource to quickly get liquidity into the estate to pay bills. And then also from the perspective of estate planning, life insurance can play some interesting roles because you can gift the premiums. And then if you, or you set up like a life insurance trust where as long as you live for another 3 years, the what goes into the estate is like the premiums that you paid rather than the death benefit. So I could basically making up numbers, but like gift now $1 million to pay for a life insurance policy that's going to pay $15 million upon death. Uh, if as long as I live another 3 years, only that $1 million would go into the state limits. The $15 million death benefit exists outside of the estate limits. So that can be a strategy to help people manage estate taxes as well. And
Gotcha.
there are a number of other related irrevocable trusts that you can use as a process of help managing estate taxes. And I do outline the basics of how those work in the Retirement Planning Guidebook. But for that sort of issue, you really do need to be working with a professional, like a estate planning attorney, knowledgeable with the rules in your state to get the most effective use of those types of strategies. So we won't get too deep into the weeds with that.
Okay. And you started to get into trust on for estate taxes through the use of an insurance vehicle. Do you want to get into that more, or is that enough of a intro?
Well, that's probably enough of an intro. The whole basic strategy is with these irrevocable trusts, you make a gift so that what went into the trust is what goes against your estate. And then any subsequent growth or appreciation or life insurance death benefit, all that growth exists outside of the estate. So it's a way to gift more without having to pay the estate taxes on it. That's the basic idea that feeds into using trusts for estate tax reasons. But those have to be irrevocable trusts because the gift, you can't use a living trust to avoid estate taxes. You
Now,
have to make that gift and it has to be, you have no longer control over the asset.
for semantics, can you please make a quick distinction between irrevocable versus living?
Yeah, an irrevocable trust can't be changed in the future. You have no more control over that trust. It exists outside of your control. Whereas a living trust is also called a revocable trust. You can make changes to it. But if you can make changes to it, it means you maintain control over it, which means it hasn't been a completed gift for the purposes of gifting within the IRS rules.
Okay. And the last part that we wanted to cover was the RMDs on inherited accounts. I jumped the gun on it, and I think I may have confused more than elucidated, which is probably a reoccurring theme. But for RMDs on inherited accounts, you want to touch base on that just to lay it out for folks?
Yeah, yeah, and so that's inherited IRAs and inherited Roth IRAs. They have their own special rules, and we get a lot of questions that come in about this because there's so many scenarios for how it works, and this is something that's the Secure Act changed dramatically back in the end of 2019, and then also the Secure Act 2.0 a couple years later made further minor modifications. But the basic issue is the lifetime stretch idea that people had in the past. A lot fewer individuals will be eligible for lifetime stretches. There's now 10-year windows, but maybe it's really worth going through the scenarios. There's a
Yeah.
exhibit 11.1 in the Retirement Planning Guidebook outlines this. There's a lot of potential scenarios. It's about, so for an IRA or Roth IRA, or other employer plan, did the owner or participant die before the required beginning date for required minimum distributions, which is April 1st in the year after they reach the age where RMDs begin, which is now 73, but will be 75 for people born in 1960 or later. There's a set of rules for if they died before reaching April 1st of the year after the year they reach their RMD age, or if they die after April 1st of the year after the age they reached their RMD age. And then there's different rules for whether that death took place in 2019 or earlier, or whether that death took place in 2020 or later. And then there's different rules based on the type of beneficiary. Spouses get the most flexibility. So spousal beneficiaries, non-spousal beneficiaries, and then non-person beneficiaries all have different types of rules. So the big highlight coming out of all that was with the non-spousal beneficiaries, adult children,
Yeah.
kind of the example I have in mind. Before 2019, they would get a lifetime stretch, which allowed them to distribute that inherited IRA over their remaining lifetime using Table 1 of the IRA.
Stretch is the word for the length of the distribution, like
Yeah, or
it's
stretch over the
stretching it out.
lifetime. And if you're an eligible designated beneficiary, you can still use that lifetime stretch, but like adult children will tend to not be eligible designated beneficiaries, which means they now have a 10-year window to spend down an inherited IRA. Now, if the death happened before the required beginning date of the owner, you could wait until year 10 to take everything out if you want, although that, for tax reasons, you might want to spread it out over time. But if the owner's death happened after the required beginning date for taking RMDs, there is also a required minimum distribution every year in that 10-year window, with the remaining balance having to come out in year 10. And that was a thing that was unclear for a few years and was excused from 2021 to 2024. But in 2025 and later, if you have an inherited IRA and you're a non-spousal beneficiary and not an eligible designated beneficiary, and was and that individual passed away after April 1st of the year after they reach the age where RMDs begin, then you do have to take an RMD for each of the 10 years. And any remaining account balance has to come out in year 10.
And just to be clear, this is gonna be taxed at your income level. That's why
Mhm.
the timing of these payments for somebody, let's say in their 50s, is important because let's just assume that, from a career perspective, that's most likely going to be a high earning year for these folks.
Yeah. Yes. So taxable assets don't have any embedded taxes because of that step up in basis. Roth assets, though there will be the RMDs to distribute them, there's no taxes due on that. Income taxes. I mean,
Because
there
you've
could be an
already
estate
paid the
tax,
tax.
but no income tax. But inherited IRAs have an embedded income tax liability. Those distributions are now taxable to the beneficiary at their income tax rates. And if those accounts are big enough, like if the estate's big enough, there's an estate tax bill, and any estate taxes paid, you get to offset against these income taxes. But if there's no estate tax issue, there's still this embedded income tax liability. Now that gets into like if you are charitably inclined, IRA assets are often the most powerful asset to leave to a charity because that embedded income tax liability, well, if the charity gets to pay at a 0% tax rate, let them quote unquote pay the tax bill at 0%, leave that
Mhm.
asset to the charity, and then leave other assets to the other like child beneficiaries and so forth.
And how does the just to make it clear to everyone, what are the key differences between the Roth and the regular IRA from a distribution standpoint?
Well, there's not a lot of key differences. The key difference is those required minimum distributions from the inherited Roth IRA are not taxed. They have to come out, but they're not taxed. And then what you
The
can simply
time
do is reinvest them in a brokerage account.
the time is the same though. The time in which they need to distribute, is it the
Yeah.
same or
hmm
not?
hmm
The
Now, spouses have a lot of options and a lot of flexibility for inherited. They could just pull it over into their own IRA and use their own age for RMDs. They could leave it in the name of the deceased. And if that person was younger, maybe they'll get better RMD treatment that way. Uh, yeah, they have more flexibility than other types of beneficiaries. And then the beneficiaries with the least flexibility are like the non-humans, the estate or charity or other certain types of trusts. They have either a 5-year window to take the distributions if the death happened before the required beginning date, or um, a type of lifetime stretch, but a less advantageous one if the death happened after the required beginning date.
that about covers it.
Sure does. Yeah. But yeah, this is these details are all accounted for in Chapter 11 of the Retirement Planning Guidebook because yeah, there's a lot of the complications associated with that. I also did
Yeah,
talk about taxes on inherited annuities at a very basic level because that gets even more complicated than inherited IRAs and Roth IRAs. And then also a caveat on inherited health savings accounts. That's like an inherited IRA, but with a 1-year window to take the distributions. So that's where if you leave a big inherited HSA and you didn't leave your receipts for them to offset, they may have a big tax bill due in 1 year for that account.
got you. All right, folks, you heard it here, and you can read it in chapter 11 of the Retirement Planning Guidebook.
That's right. And
All
we're
right,
getting closer to the end of the series, but we'll continue on the next episode with the non financial considerations of
that's right.
retirement.
All right, everyone, thank you for listening to Retire with Style. I'm Alex signing off. Wait.
Thanks, everyone.